We're live.
Hello, everybody. Simon Dixon here. Hope you're doing well. We should be live on YouTube now if everything's working. Happy to say that Zoom is back. So we finally got the account sorted after lots of harassment on Twitter. So thanks for everybody that helped with that. And today we're going to be discussing the solutions and how to stop the Great Depression of 2020. Just before we jump into the content, can you let me know where you're tuning in from? Let me know if the sound's coming through good, if you can see me good. We've got a slightly different setup today. I've actually been booted out of the office because the studio is all in motion. The builders are all here and we managed to get them over the border after their quarantine. So really excited about the quality going up once we got all that done. If you could like this video, that would be great. Want to see as many people do that. Really excited that we got almost 300,000 views on the video on Take Your Money Out of a Bank. And then we did the follow-up, which got about 30,000 views. Let's see what we can do this week. So today's all about what you're going to see covered in the news. Firstly, no one's really referring to what we have today as the Great Depression of 2020. You're not going to hear it referred to that probably until 1 to 3 years, especially as the US election is kicking into second and third gear. Now that it's really, I guess in just over a month now, 5-6 weeks, until we have the US election, which is a very important election in terms of the effect and impact it will have in the years ahead. And who will be blamed ultimately for the Great Depression of 2020? The reality is it's completely systemic, but left and right like to argue around how it was caused by the other person. The right like to say that the left spent too much money and they were too greedy, and the left like to say that the right didn't spend enough money and they were too greedy as well. So today we're going to be talking about solutions to the Great Depression of 2020. Just before I jump in with that, could you let me know if you can hear okay? Azad is here moderating. He's going to be picking out questions. The first half, we're going to be covering content. The second half, we're going to be covering all of your questions. So get those ready. I'm on Twitter at Simon Dixon Twit if you want to tweet me any questions. And you can use the comments if you're watching this recording on YouTube, or if you're here live. Thank you very much. Azad, how many people have we got live at the moment? He might be on mute.
We have about 100. Sorry for that.
Okay. All right. We got 100 live. So normally, hopefully a few more will kick in. Let's go straight into the content. So when I studied about 20 years ago, when I started my studies in economics, this was really the rage was talking about the different theories of depression economics. And really, economics was a science that came from the last Great Depression of 2020. So prior to that, it was more of a social science, I guess you should call it. And then really after the Great Depression, the lessons of the 1930s Great Depression were really where economic models started to come into play. Now, the interesting thing today is that economics has progressed significantly, but it's still just as disjointed and completely unresolved as it was way back in the 1930s. We have not reached consensus on models of depression economics, and yet we run our economy as if we have resolved it and it is a science. So what I think you're going to see over the coming months and going on, past the US election and into 2021 and beyond, is you're going to see lots of different economic thoughts around how to resolve and how to stimulate the economy. And you're probably seeing it already from different schools of thoughts. And I'm going to share what I talked about in my book, Bank to the Future, Protect Your Future Before Governments Go Bust. When I started writing that around about 2010, when Bitcoin was first created, and it turns to be the first published book on Bitcoin that included Bitcoin, but it was mainly around monetary reform, banking reform, and some of the things that we can discuss today as well, and we can update. So the first thing that you're going to hear about of what we should do to get out of the Great Depression or to turn the economy right now is Keynesian schools of thought. And Keynesian is a very famous economist. He was at the Bretton Woods meeting. He was one of the people heavily involved in advising the government around the monetary renegotiations that we had in 1944 and Depression economics as well. And essentially, in a nutshell, in here, the Keynesian thought and how people attribute Keynesian economics today is essentially a fiscal stimulus. That's a fancy way of saying governments need to spend their way out of the depression, because in a time of depression, demand, essentially the whole of economics is about supply and demand. And in times of depression, demand goes down because nobody really wants to spend money. They can't borrow money because banks are allocating less capital. And you have a contraction in the overall spending and people hoarding, which reverses the effects of economic growth. And so therefore, the Keynesian theory is that during these times of recessions and depressions, the government should actually spend their way out of the depression. Essentially, the interesting thing about Keynesian economics is the right-wing people and those that believe in more classical laissez-faire economics, which we'll go through in a bit, will tell you that it's Keynesian economics that is responsible for the financial crisis, the debt levels we have, and really Keynesian economics is responsible for that. But what is interesting is we actually don't have Keynesian economics. So if you return back to my video that I published in 2010, where I called it the Great Depression of 2020, where I was talking about the trends that would lead us to a Great Depression in 2020, I was talking about Keynesianism and monetarism. And essentially, the way that Keynesianism works is that you need to spend when the economy is depressed, and you need to inflict austerity measures, tax cuts, and pay down debt in boom markets. Now, what we tend to have is, because the financial system, if you've watched any of my previous videos where I talk about the systemic risk of the banking system driving governments, individuals, and corporations deeper and deeper into debt, is we have a system that essentially needs to rehypothecate, find new markets for debt, whether it be student loans, whether it be mortgages, whether it be toxic assets, whether it be credit cards, whether it be quantitative easing, whether it be creating money to lend to government, whatever it may be, you just need new markets for debt. And 2008 was the innovation in getting people that couldn't afford a deposit to buy and stimulate the mortgage rental markets, the mortgage markets rather. But the interesting thing about the criticisms of Keynesian economics is we don't actually have an experiment of Keynesian economics. The reason we don't have that is because the financial system in the boom time doesn't pay down its debt and doesn't really implement austerity measures. Why? Well, they don't implement austerity measures because every 4 years there is an election in the US, and the person that wins the election is always the one that promises the most to people. And so what you'll start to notice is that even if some people are kind of right-wing on the Trump camp at the moment, you'll notice that Trump has spent more and the debt's gone up more and more and more, because the systemic nature of the system means that you always have these events that require people, in order to win an election, to spend more money, to promise more, so they take on more debt, and therefore they can win those votes. So as long as people still vote based upon what they can get from the government debt will always increase, and it will go up again and again and again. And then during the boom times, when they're meant to be paying down, they promise more and they spend more. And therefore, you never actually get an experiment of whether Keynesian economics actually works, which is the government takes on the debt and stimulates and takes on the demands that the corporations and individuals aren't providing. They step in and then they step out during the boom. But most people consider Keynesian economics as just spend more, spend more, spend more. And therefore you have that area, and it tends to be associated with left, because when governments spend money, you can allocate what they should be spending that money on. And left-wing people tend to argue of all the things that they'd like the government to spend money on. The criticism of that is essentially that when you go for Keynesian during the bear market and depression or recessions, is you increase the level of debt exponentially, and then they continue because of the systemic nature of, if you pay down debt, it causes recessions and depressions. And so they never actually get to pay down that debt during the boom markets or the good markets. And therefore you just have a ballooning debt cycle whereby the economy gets addicted to the drug of debt. And you have to find this new innovation, which is what you tend to have. And this is where, because the governments have essentially outsourced the money creation process by allowing banks to create a digital currency every time they issue a loan, you have the world's largest regulated Ponzi scheme that I've talked about many times in previous videos. And so the criticism is that Keynesian economics just practically cannot be implemented, just due to the nature of money creation requiring more debt in order to have an economy. The second form of policies that you will be seeing is the one that we do actually see by central banks. And this was popularized by a famous economist called Milton Friedman. Milton Friedman came from the Chicago School of Economics, and that is a more modern version of classical economics. And classical economics was really popularized by Adam Smith. Adam Smith believed that you should leave the economy to the private sector, and that there are few things that government should do. And you have a Schumpeterian style creative destruction, whereby the least efficient entrepreneurs go bust and more efficient entrepreneurs thrive. And you have redistribution from inefficient companies to more efficient companies. And the belief is that the government are the most inefficient people at spending other people's money relative to corporations or individuals spending their own money, and therefore you should leave the market to do what it does. And monetarists, which was essentially popularized by Milton Friedman in his general quantity theory of money, believes that you can increase and stimulate the supply of money by controlling the interest rates and also the actual supply of money. So with interest rates, what you're doing is people are demanding that interest rates go down to zero, simply because when you put interest rates down to zero, it's stimulating debt, and it's trying to encourage banks to actually borrow very cheap money and then use that as collateral so that they can stimulate the lending market. What tends to actually happen, though, with the lowering of interest rates is it increases the profitability and margin because they don't pass on those benefits of the loans. They only go to crony capitalism, which is those that are connected to these government loans through crony capitalism. And essentially, the way that you get out of a depression is you try and reverse the market by actually lowering those interest rates, stimulating debt, and then you can do more modern monetary theories like quantitative easing, where essentially the central bank creates brand new supply of money and borrow and essentially purchases government debt through the bond markets, or purchases corporate debt through the junk bond markets. And during a boom time, you are meant to increase those interest rates so that you can take the same people that borrowed the money that saved the economy, put the interest rates up and send them bankrupt because they can no longer afford to repay those loans, in order to control the side effect of this, which is inflation. So many people ask, with all this new government created money that's happening, well, not government created money, central bank created money, is that going to cause inflation? Well, if you look at all the history and all the archives and all the history books, it has shown that even when you increase the money supply, If you do that during a recession or a depression, it is non-inflationary. But if you do it during a boom market, it can lead to runaway inflation, hyperinflation, and some of the things that we see in some of the countries where the currencies are actually being destroyed right now. And so monetarism is really the school of thought that most central banks, most economists subscribe to right now, and is really dictating our economy. Now, when you lose things like interest rates, you end up having to look at more exotic tools like quantitative easing, which is what happened in order to get a big turnaround and shock to the economy. Now, what's interesting is institutional investors have at this stage decided that we don't trade based upon market fundamentals anymore. They keep their money in the stock market and allocate money to the stock market based upon central banks. So market economics does not exist anymore. You essentially have central banks trying to stimulate confidence of institutional investors, and institutional investors pump that money into stock market. And if you can stimulate it through buying corporate bonds, then the corporations use it to buy back their stocks. And you get this disjointed economy like we have today, where the reality of unemployment, a contraction in the growth of the economy, ginormous levels of bankruptcies and debt is not being reflected in the reality of the markets. Because these two things are not computing when you have a central bank and institutional investors investing only upon the confidence that the central bank will create more and more and more to turn the economy around. The criticism of monetarism is essentially it creates asset price bubbles. Because what tends to happen is the money that is created through quantitative easing or through the lowering of interest rates doesn't make its way to the everyday people on the street. It only makes its way to those that are most connected to the central bank. And the most connected are those that are most connected to the investment banks. And the investment banks are the ones that have been IPOing the large companies, making those large companies public, and stimulating them through debt capital markets and equity capital markets, i.e. the stock market and the money that they can borrow as a result of that. So what that tends to do is, because the wealthiest and the largest corporations with the largest reserves are the ones that get first access at that money, because they've got reserve money, they tend to use it to stimulate assets. And so this can be used by banks borrowing it, so then they can issue more mortgages, and then that stimulates the property and real estate markets, and you get asset price bubbles, which is what we're experiencing right now, where assets such as real estate have reached a price where they're crowding out the income and the wages of ordinary people that just simply can't afford to buy those assets. And so only the rich can purchase those assets, and the banks can actually lend them, make loans against them. And if people default on those loans, they can repossess the assets. And during a depression, a bank can essentially, through the fact that you've got all these schemes that guarantee the banks, they can suck up all the assets from the bad mortgages and loans that they were making during the boom markets. So essentially what this does, the criticism of monetarism, is it creates these asset price bubbles where the stock market and the real estate markets and the bond markets get very disjointed from the reality of the economy and the figures that you actually see. So those are the two different things. So you've got Keynesianism, you've got monetarism, and then you've got what's called the Austrian School of Economics. Now, the Austrian School of Economics is a subdivision of classical economics, which believes that you should leave the government and the Federal Reserve. In fact, you shouldn't even have a central bank. The central banks have no role in the economy. They believe in things like systems we used to have, like gold-based money, where we had a gold standard. which essentially kept governments and central banks into check, because if they took on excessive levels of debt, their gold supplies would then end up leaving the country to another central bank. And so really, in terms of Keynesianism, you're going to hear people like very famous Keynesian economists like Paul Krugman, who's a very famous journalist and economist, that would be pushing right now what the government needs to do in order to get out of this depression is they're not spending enough money. They need to spend more. They need to keep interest rates down. The monetarists would be saying keep interest rates down, stimulate through quantitative easing. And the third type, the Austrians right now, would be saying you need to increase interest rates. They'll be saying that the economy is suffering because of too much government intervention, too much Federal Reserve and central bank intervention. Therefore, you need to suck it up. You need to depress the economy. We need to get back. We need to balance our books. And we need to move our monetary system to something more sustainable, that keeps the governments in check, like a gold standard. And so, really, the school of thought with the Austrian economics is you'll be hearing famous economists or investors like Peter Schiff is someone that you'll hear about a lot. He'll be talking about how you need to essentially can rein in the money supply, abolish central banks, move to a gold standard, increase interest rates. And the effect of that, essentially, if you did that right now and really rein in the government and really decrease the size of the government and stop interfering in the economy and allow the markets and the private sector to really readjust itself and figure out what the market wants, not have this crony capitalism whereby the government is spending money on certain companies, certain policies, and if you can get that money, then you can save certain companies. The criticism of that is that while I can empathize with the Australian School of Economics, it's just not the reality that we live in today. So if you were designing an economy from scratch and we were starting again and you were trying to design a monetary system, then you might consider the Austrian School of Economics. And I think it would be more sustainable to do that. But you've got to take the reality of where we are today. So if you took Austrian economics and you increased interest rates, the first thing is that would create systemic risk in the entire banking industry. There would be mass defaults on all those debts. And you definitely go sharply into a really, really steep depression. Because the banks are all in systemic nature of it, you'd end up with ginormous defaults and you get corrections in real estate prices, which is a good thing. Real estate prices are out of control. They need to be more affordable for people to actually purchase. But the reality is that the way that they've engineered the economy is if you don't have a monetary renegotiation and monetary reform at the same time, you'd enter into a worse Great Depression than you would in the 1930s. If you increase those interest rates, you'd have a run on the banks. You'd have people, the banking system collapsing. And then we'd be looking at either the left would be saying we need Keynesian economics, the right would be saying we need to spend less, we need to suck it up, we need to allow it to happen. And you'd get a ginormous rich-poor divide as well. So you can see that there's criticisms of all of these different things because of the different schools of thoughts. And you're going to see that play into the elections and politics at right now, because the way that you react is even if a right-wing politician believed in this style of economics, the reality is they can't get the votes unless they promise more, spend more, and that's what gets them the votes that they actually need, because causing a depression in order to correct the economy is not going to be popular. So therefore, we're only left with financial engineering and crony capitalism in order to actually get us out of this depression now. So it's not that I disagree with Austrian economics, it's that it's very impractical given the situation that we are in today. So what can you do today in order to get out of this Great Depression? Well, the cold hard reality is I've talked about it in lots of my videos, and I talked about it in my book, Bank to the Future, Protect Your Future Before Governments Go Bust. If you haven't already subscribed to my YouTube channel, Simon Dixon, please head over to there and hit that subscribe button, hit the bell symbol. Really, really happy with the level of growth and how many people have been sharing this. If you've enjoyed the content right now, please do like this video, because the YouTube algorithms are actually favoring us. A few weeks ago, it looked like we were shadow banned. Now everyone's telling us that we're getting notifications. So if you could like this video, it would really help us. And if you could share it and also subscribe to the channel, and each and every time we go live, you'll actually get that notification. So really appreciate that. There's the three different schools of economics. So what can we actually do right now that I talked about in the book? Well, the reality is that you need to inject a new money supply, not based on debt. So we are in a debt crisis, and we're going to solve a debt crisis with more debt. That would be the Keynesian way of looking at the depression right now. Do a fiscal stimulus, also use monetarism and quantitative easing. Interest rates are down, so you don't have that tool. So you look at quantitative easing in order to have a monetary stimulus that then funds the fiscal stimulus, and government spending is what we're going for right now. The problem is that we're doing that by stimulating debt, which is the reality of we need to move into a monetary renegotiation whereby a new money supply is created that's not based upon debt. And this is why I think when none of these policies work, when the Austrian policy drives us into a deep depression, when the Keynesian policy drives us into excessive debts, and when the monetarist policy drives us into asset price inflation and asset price bubbles, eventually shit hits the fan and we have to have a Bretton Woods style monetary renegotiation. I've covered this in many of my other videos, so you can look at the real estate market crash, which was when I recently covered, and you can look at other videos that I've covered on this subject. That new money supply is going to come as a result of central banks all around the world and governments all around the world looking at Bitcoin. They've all been looking at Bitcoin, and they all want to launch their own central bank digital currency. The interesting thing about a central bank digital currency is that I don't believe it will be backed by debt. And I believe it will be incredibly disruptive for the private banking sector. And it will be used as a weaponized tool to get more control over the population. And so where I've talked about in previous videos, the effect it will have on your personal liberties, your personal freedoms, and just general privacy in general, which is a human right, which is essential for human society to operate, the effect it will have will be disastrous. But it won't be a debt-based Ponzi scheme. In fact, it can be used as a mechanism to deleverage the economy, get us out of a depression by injecting a money supply that is non-inflationary, because it's actually backed by the proportion of debt that gets extinguished from economy as banks go bust. Sorry if that's a little bit of a mouthful, but I've covered it many times in previous videos. So check out the archives at Simon Dixon if you're interested in learning a bit more about that. I'll also be covering what I think as an investor we will be doing, what you should be doing at every eventuality of this Great Depression of 2020. That video series will be coming out really early in November. If you were a shareholder in Bank to the Future, you'll be receiving that video series before everybody else. We covered that in previous videos as well. If you wanted to actually still become a shareholder in Bank to the Future, make sure you contact the banktothefuture.com team. For those of you that don't know, that's the company that I'm the CEO and co-founder of, and we covered that in previous videos. But we'll be going through in this free video series that will come out in November. It'll be coming out first in October to our shareholders. In November, I'll be going through exactly how I'll be investing my funds in this Great Depression of 2020 based upon the trends that I think are coming right around the corner. And that will be based upon what I think the different economic schools of thoughts will be doing to get us out of this Great Depression. But the simple answer, what should we do? We need a ginormous injection of non-debt-based money into the economy, and it needs to be proportionate to a deleveraging of the banking system based upon the trouble and hardships. And then we need to allow the economy to correct itself and allow some of the asset prices to go down so that we can reach a more sustainable school of thought. Now, what is really interesting about today is we can actually have the best of all of these schools of thoughts. In terms of Austrian economics, the movement towards moving back to a gold standard, while that would be brilliant to keep governments in checks and governments' debt in checks, I don't think that's what we're going to be seeing in the next monetary renegotiation. But we do have laissez-faire, free market, capitalist money in the form of Bitcoin. And now people can use that not as a substitute for fiat money, because it does different things than fiat money, but it gives us the ability to have a completely fixed money supply, a digitally scarce asset, and a monetary system that's being built outside of the debt-based fiat Ponzi scheme. At the same time, we can have central bank digital currencies, which can be used to drive us into a more sustainable economy by replacing bankrupt bank debts, a deleveraging currency, but only use it short term, because the effect it will have on your privacy, your personal freedoms, your liberties that I've covered in previous videos is going to be the world's worst form of money that we've ever seen, but it will be sustainable. It will be really transparent and clear whether the governments have created inflation or deflation. It will be really clear because there will be a much, much clearer money supply than the current system, whereby we use Keynesianism and monetarism in order to stimulate how much digital currencies the private banks create, all backed by debt. So now we can have the best of all worlds. Central bank digital currencies can allow for monetarism and Keynesianism. And Bitcoin, and it can be used in order to remove debt-based private digital currencies that are created by the private banking sector. Banks can just simply become what they were originally were, intermediaries between borrowers and lenders. And when investors give permission to use their deposits for different things, and then it can be used in order to invest into capital markets and all sorts of other things. And Bitcoin can be the laissez-faire, free market, Austrian fixed supply, or that can be an exit from the traditional financial system. And essentially the fiat money can take away your freedoms, and Bitcoin can be something that can drive those back as you have these two markets competing and keeping the other more honest. When you have the ability for people to exit into something like Bitcoin, then that also keeps fiat currencies more honest, improves them, because when you get these outflows of money into crypto like we're seeing right now, they come up with more innovation and more things. The problem is that whenever we have these black swan events like 9/11, which led to Patriot Act and removal of many freedoms, and then you have the pandemic that we're having right now that leads to massive fear into people, that drives people to giving up their personal freedoms and privacy. Those laws do not get reversed, and they get integrated into the central bank digital currency, which eventually becomes an AI-led money, which automates tax collection, enforces government policies, and you get this more in 1984 style, George Orwellian style form of money in terms of the impact that it has. That's where I think we're going to go. There is give and take in this. And I think that the monetary renegotiation that I think we're going to see either in 2021, 22, 23 will be the trigger based upon all of these different economic schools of thoughts being experimented in what we're seeing as one of the most interesting times in financial history. And I think that's a good place for us to head over to the AMA and start taking some of those questions. How did I do? 36 minutes in. We've got 25 minutes to cover as many questions as we can. So Azad, what have we got in the live chat? Just while we're pulling that up, please do remember, like, share, subscribe. I know I don't want to ask just as much as we do, but it really helps us get this message out in times when I want more and more people to be completely prepared for what comes next, because you can. So Azad, what questions have we got?
Yeah, we got a lot of questions coming in. We've got about 400 people, over 400 people watching us right now. So let's start with the first question. If Bitcoin becomes a world store of value, would governments base their fiat on BTC, Bitcoin, like what they did with gold in the good old days?
That is something that certainly is an option for countries, but I don't think that many countries will take it. It's theoretically possible that Bitcoin could become a world reserve currency. The definition of a world reserve currency is that central banks hold it on their balance sheet, just like they do government debt, gold, dollars, and their national domestic currency. Many countries right now, they're having to, current countries in crisis are having to get rid of many of their US dollar reserves. So we're seeing that in countries like, Lebanon that have had crisis, where they're working through and they're chewing through all their dollar reserves. Their currency has become worth less. And they're trying to claim some of those gold, like we're seeing certain countries like Venezuela is trying to claim some of their gold back that crazily they stored in the Bank of England, and the Bank of England's just simply saying no to them supplying the gold. That said word, a lesson for everybody that is currently storing their gold in Switzerland and Singapore and is doing it with a custodian. Remember, when you hold your gold with a custodian, it means that in times of extreme circumstance, you can't get access to your gold. Same with Bitcoin as well. But getting back to the question, could we see this becoming, I've covered this in previous videos where I talked about how Bitcoin could become a world reserve cryptocurrency. I think I said how it could happen by 2020. Go back to that video on my YouTube and I'll go through the game theory of how that could actually happen. And it starts with smaller central banks deciding to make an asymmetric bet, like Bulgaria did when they confiscated 200,000 Bitcoin from a criminal organization, and those Bitcoins became worth more than the entire national debt of the country. I think other countries are going to take that bet, and then they can announce it, and you end up with a countrywide FOMO, fear of missing out. And then the last countries to adapt are the ones that lose, which will be the larger, more incumbent ones at the moment. But I don't think we're going to see in the monetary renegotiation all of the superpowers sit around a table like they did in Bretton Woods and decide how they're going to use the dollar as that world reserve, but this time with Bitcoin. I don't think we're going to see that. If we do see that, I think it's going to be more of an organic, rather than politicians and officials and central banks sitting around a table. It could happen more of an organic as people start to use Bitcoin for their savings, and then they start to use it through some of the financial innovation we're seeing, where you can use it as collateral to exercise and get different products. And when individuals do that, you could then see companies doing that. And when companies do that, you could see governments doing that. And when governments do that, you could see central banks doing that. So it might be a bit more organic, but I don't expect that to see anytime soon. But the good thing is that doesn't really need to happen as long as individuals see and the potential of this fixed money supply and the ability to own their own money and spend their own money as something they want to do. Then each and every year since I've been involved, since I spoke at that very first Bitcoin conference in 2011, when it was just 40 people in a room, every year more and more people see the utility of owning their own money, spending their own money, and having a fixed supply. And I don't expect that trend to reverse anytime soon.
All right, thank you. We've got We've got quite a few interesting questions come through. Some of them are statements, but this one's quite interesting for me anyway. I'd love to hear Simon's opinion on the end game. Is it a reset, a fresh start? Is it a global ruling power and a world of automations? Are we all going to Mars?
So I think I kind of hinted it, but let me spell it out a little bit clearer. I don't think you get a reset. I think you get a monetary renegotiation. I think it's going to be done at the government level through central bank digital currencies. And the loser of that is sustainability. You have the winner is sustainability and the deleveraging, but the loser is privacy and freedom. You have competing systems where you have private forms of money, laissez-faire forms of money, where people can exit from that. Essentially people can choose these, battle it out, and you have more competing forms of money. That drives, I think, I don't think this is the end. I don't think that we're going to have a reset. I think we're going to have a renegotiation, but I think there's going to be some big winners and big losers in different markets along the way. And that's what I want to really be covering in the 4-part video series that I'll be releasing, called, on exactly how I'll be investing, so that people can see what I'll be doing and they can see if that's how they want to do that as well.
Okay. We've got a question saying, are the situations of Europe and the US similar?
No. So the difference with US and Europe. So firstly, the US dollar is a significantly stronger currency than the euro. The euro has done incredibly well in terms of becoming a significant player in the currency markets. But really, the US and China are really the games in town. But China's diversifying away from US and investing in European debt, European bonds, and they're their second largest export market for their goods. So Europe is a significant player. When we say Europe, we might as well say Germany, because Germany has all the influence in Europe. And the major difference with Europe and America is that approximately 70% of all currency is dollars, and 50% of all transactions globally are made with dollars. There's nothing like that when it comes with Europe. And the fact is that Europe never had the government fiscal integrations that was the original vision of Europe. Europe had some really great things in terms of the free flow and movement of people, jobs, and that was really positive stuff. But the problem was that many of those countries opted in to the policy of the European Central Bank. Now, the difference in America, you kind of have all these different states, and you have federal policy and a Federal Reserve. In Europe, you have really disjointed language barriers, countries that don't see themselves as one United States, as it were. And therefore, these countries, when they try to exercise monetarism in order to re-stimulate their economy, who controls the issuance of the European Central Bank digital currency? Well, it's the ECB, it's the European Central Bank. But the countries that gave up their currency don't have any say or influence over that European Central Bank policy. So they all need to fight for the stimulus packages in order to do that. So that is very different to the situation in the United States. And so really these two different things, they all have very similar in that they're all running debt-based Ponzi schemes. But Europe is in a much worse situation than the United States in terms of the tools that they have in a monetary renegotiation. In terms of those that have the highest level of gold reserves, Germany, representing Europe, has a large gold to GDP, so that will buy them a seat at the monetary renegotiation table, but it's not as large as China, Russia, and America. Just going to take a quick water break. While I do that, please do take this opportunity to like, share, subscribe. Awesome. So there are slight differences, and Europe is in a much, much worse situation in terms of tools that they have. It's correct that America is running a much, much greater level of debt. And so, the debt levels in America are significantly worse. But the economics of the tools that you have by giving your monetary supply to the European Central Bank means that what's right for Germany could be disastrous for Cyprus and Greece, which is what we saw during the 2008 policy and QE and European debt crisis as well.
Okay, I think before this whole pandemic happened, there was obviously big news everywhere about Edward Snowden. So we got a few questions, a few people asking, what's your view about Edward Snowden? What is the fate of Edward Snowden? They'd like to know if you've got an opinion on that.
Yeah, I don't really know the fate of Edward Snowden, but my expertise on this subject is no more greater than most people. I've watched the film, I've read the books. I think it's a massive, massive injustice. I think he did a huge service to the world. And thank God economies compete, and he's found himself in a position where he's got, he's able to live his family life in Russia. I'm not quite sure what would have gone on in order to get that safe harbor in Russia. I'm sure it came with some types of conditions, and it's a political conversation that is beyond my pay packet and understanding. But I think Edward Snowden did, he'll go down as a hero. Many people see him as somebody that was a traitor to the US. Others see him as a hero. I think that the revelations that he exposed the world to are actually really exposing some of the most greatest political issues that will actually lead to elections being won in the future. But unfortunately, it's not really going in that direction. Because of this pandemic, it reversed the effects of the big debates and conversations that came out of the Snowden revelations. And instead, we're moving in the opposite direction. And I think Snowden has also become a very big fan of the opportunity of having private currencies like Bitcoin. We're grateful to have him as part of the Bitcoin community. But what happens to him? That's a politics conversation. I have no idea how to forecast that any more than the next person. But the impact that Snowden has had, unfortunately, has been reversed by the pandemic when it was getting in a really, really interesting direction prior to that.
Thank you. What does Simon think about the IMF, who recently tweeted support for crypto?
So I gave a video on the IMF and World Bank. It wasn't titled very well for people to actually follow it, but it was in relation to India's response to the pandemic. And I think it was called the Indian financial crisis. And they were about to take a loan. And I went through the flow of funds between the parasitical organization called the IMF and the even more parasitical organization called the World Bank. Check out that video if you want to know more about the impact that the IMF and the World Bank has on developing countries and how it relates to global world central bank digital currencies and currencies that exist right now, like special drawing rights. I'll put that one to the archive. But the IMF has actually been doing a lot of good research. It tends to actually push Keynesian economics in terms of their school of thought and Keynesian research as an allegiance in terms of what it actually does and what it and who it is. But the IMF have also, I think the reason that they'll be printing about their support or pushing and tweeting about their support of the crypto industry is because they are definitely going to be releasing their IMF central bank digital currency, whatever you want to call it. It's not quite a central bank, but it does have its own digital currency called special drawing rights. And I think it's going to want to release its own one in order to kind of roll up as a lender of last resort to the central banks that are experiencing real distress at the moment. and you'll get a stimulus package from that central bank digital currency. So of course they're going to be promoting crypto, getting ready for that conversation. But we've seen this in the past when the banks tried to take down Bitcoin by popularizing the phrase blockchain and trying to take out the word Bitcoin. It actually drove more and more people into Bitcoin because Bitcoin was really the only blockchain that actually worked and had utility. And so therefore it can kind of work against them. So pushing these central bank digital currencies can often drive people to more adoption for Bitcoin. So it's kind of worked in that way. And I think IMF will also do that. They did release a great deal of research kind of countering some of the arguments that Bitcoin is a currency just for drug dealers and terrorists. And they proved that a massive, massive part of that actually happens through fiat currencies, through US dollars, and the amount of that happens in Bitcoin is statistically insignificant. And we're also seeing more and more of that with the FinCEN file leaks at the moment, showing many of the fraud and money laundering that is happening in dollars through the private banking sector that is completely dwarfs anything that can possibly happen through Bitcoin as well.
All right, thanks for that, Si. I guess we've got just less than, we've got about 9 minutes. I guess the question is, if the stock market crashes, why wouldn't Bitcoin just do the same? And finally, Simon Dixon for president.
Not in my lifetime. I'm not American, not going to go for presidency. Ain't going to happen. But maybe a politics career on the island where I live might be a bit more manageable. We only have 85,000 people here, so it's a bit of an easier task than dealing with 350 million people in America or 1.4 billion people in China or India. But thank you very much for the compliment and for that. Now, the question about the stock markets and Bitcoin is a really, really interesting one. So initially, what Bitcoin is correlated to is the demand for people to own their own money, spend their own money, and have a fixed supply that can't be diluted. You'll see that theme. I've been talking about that ever since I first discovered Bitcoin in 2010. And I've been saying it at presentations ever since for the last decade. That those are the three things that drive demand for Bitcoin. More people wanting to own their own money, more people wanting to spend their money so they can do it in a peer-to-peer way, and more people wanting to get the benefits of a fixed supply that can't change. And so it's the correlation between Bitcoin and markets is we need events that help people realize, like, the 2013 Cyprus bail-ins made people realize that they need to own their money. The 9/11 Patriot Act anti-money laundering laws that over the years and decades have made it where it's virtually impossible for anyone to spend their money at large scale drives more people to want to do it peer-to-peer and take out the middle people so that the money laundering can go to law and enforcement rather than financial institutions in the middle. And money printing that we've seen during this pandemic, or the increase in the money supply that we've seen in 2020, is driving people to want to be part of that. Now, the stock market, when people actually get fear, there is a correlation between people wanting to dump stocks, dump Bitcoin, dump gold, dump everything and move into cash because they think that the US dollar, cash is king. They're not really factoring in some of the bank risks because if you hold it at a bank, then you're subject to the bail-in. And so they, instead of holding it at a bank, they might put it in treasuries, which essentially is backed by the credit rating of the government and not subject to bail-ins. And so what people are doing is they're dumping assets in times of fear, go into cash and then taking that cash and trying to get yield by lending it to the US government. That's a typical move. Now, when people start to realize that they need to own their own money, spend their own money, and have a fixed supply, that's when it increases the utility and demand for Bitcoin. It also increases the demand and utility for gold at the same time. But the stock markets are actually stimulated by the central bank saying that we're not going to let stock markets fail. And so as long as central banks have now decided we'll take the other side of every trade through crony capitalism, then people will continue to invest in the stock markets. So stock markets are just really central banks continuing to give confidence. If people lose confidence in central banks' ability to take the other side of the trade, then you'll see ginormous crashes in stock markets. And then that might, then we'll actually genuinely get to see. So we haven't actually seen fully what happens with the correlation between Bitcoin and stock markets without central banks intervening through monetarism and QE. Once we get that, and we may never get that, then we can truly determine the relationship. But what I recommend for you to do is that when you're looking at the price of stocks or the price of bonds or the price of real estate, don't just think of it in terms of the price in your local currency or dollars. Think of the price in both dollars, Bitcoin, and gold. And then you get the true picture of whether we are in a bull market or not. And if you look at the stock market price to Bitcoin, we are not in a bull market. If you look at the stock market price to gold, we are not in a bull market. If you look at the stock market priced in dollars, we are at all-time highs. We are in a bull market. And that is due to really weaknesses in terms of the dollar, which looks a lot more strong relative to other currencies because of its strength and relative position. I know that's a lot of mouthful. It's a lot more confusing. But when I release that free video series on how I'm going to be investing in the Great Depression of 2020, I've actually had the opportunity to go through it, cover it in much more simple language, and then actually relate not just theory, but I'm going to take $1 million of my personal savings and invest it live during that video series and exactly show how I'd be allocating that. And remember, you don't have to have $1 million. You can do it with 100 million, 10 million, $1,000, $100, or even no savings, just a percentage of your income. So it's not something that you have to have $1 million to do. So really excited about releasing that. And that's probably a good time. I think that's all the questions we can take. Azad, is there anything you want me to close off with, or should we end it there?
I had one. I think you can answer this final question really quickly. I guess it's something that's piqued my curiosity with the whole craziness around the breakup of UK with the EU. We've got a question that says, do you think the UK broke away from the EU due to central bank digital currencies coming into play?
No, Britain is just crazy. Britain had the best of both worlds. It had all of the benefits of being involved with Europe and its own currency and its own central bank. And instead, the people of Britain decided to break away from Europe, taking away the fact that they had the sweetest deal in the whole of Europe, where they could benefit from all the free trade, all of the benefits of being in Europe, but still had their own central bank and their own monetary policy. So the British people really voted for Brexit, not because they really understood, I don't think, what the implications were, because no one truly understood the implications, but because they were just despondent with the government and they thought it was an FU to the government and say the people actually matter, because the government at the time didn't want to do it and the people actually got the vote and they actually pushed it through. So my interpretation of the whole Brexit scenario is it was the British people saying, you don't control the world, we actually have control, we're going to vote to Brexit, and it actually shot themselves in the foot because now they don't have any of the benefits of being in Europe, even though they had the best of both. They're not under the ECB, and it's just one big crazy disaster. It might actually turn out to be, if Europe actually tends to move to a ginormous breakdown, then they might have been the leaders and they might have been ahead of the curve. But again, the big problem with Europe is ECB, European Central Bank, currency and monetary policy of the European Central Bank and how it affects your economy. And Britain wasn't affected by that. So I think that's a really good place. I think I covered that in the 2 minutes. We're on the hour. I'd like to thank everybody for joining us. A few announcements, as I said. Please do, if you haven't done already, if you like this content, really need your help. YouTube's really starting to help us now. I think that's because of you and liking those videos, sharing those videos, and the subscribers has gone up significantly. I'm really, really grateful to everybody that's been a part of that. Please do help us more. We've got a lot further to go. There are going to be, you are alive at one of the most interesting times in financial history. A lot of people are going to get hurt. There is going to be a lot of monetary renegotiation. And you're going to be I want you to make sure that you're on the right side of that, and all your friends and loved ones. So please do help us by sharing this as much as possible and continuing that trend. Subscribe, and each and every time we go live, I'll be live next week. I think we set the topic, and we'll be live next week. And if you're subscribed and you've hit that bell symbol, you'll get an email from YouTube. So remember, you are alive at one of the most interesting times in financial history. We want you to be on the right side of that. So take care of yourself, and look forward to seeing you this time next week. Thanks, Azad. Thanks, everybody. And we will read the comments. Please do ask any questions that you'd like us to cover next week in the comment section of this video, and we'll return to that.